everybody. Welcome to Your Money Map, sponsored by the Alliance for Lifetime Income. We are so happy to have you along with us today to talk about this very important topic. Yep, it is tax time. And just in case you were wondering about the pulse of the tax situation in the nation this year, Retail Me Not is actually out with a brand new survey. They say that for 48% of the people in the country, just thinking about filing their taxes actually raises their stress levels. And this is despite the fact that 4 out of 5 are expecting a refund. But the act of filing, the act of thinking about taxes and all the different permutations that go along with your tax situation, which is, by the way, a consistently changing landscape, it really shakes people. And so we are here on Facebook and on LinkedIn to take a little bit of the fear out of the situation. And we're going to do it with one of my favorite guests, Ed Slott. Ed is, I think you could just call him Mr. IRA. In fact, I'm sure many people do. He is a nationally recognized IRA expert. He's a professional speaker. You've seen him, no doubt, on PBS, where he is one of their favorite personalities. He's also a best-selling author, and he's been named the best source for IRA advice by the Wall Street Journal. USA Today wrote, "It would be tough to find anyone who knows more about IRAs than CPA Ed Slott." Ed, welcome back to the show. Thank you so much for being here today.
Well, it's great to be back. Thanks, Jean.
Are you surprised by that statistic that 48% of people say just thinking about filing their taxes makes them stressed out?
I think so, because as the date gets closer, they start trying to collect things. I think it's just a regular procrastination thing. And there's more different things. I see people getting all kinds of letters on different credits and advance payments, things they never saw before, beyond their regular W-2s and 1099. So a lot of this, did I get that payment? Those economic impact payments, the child credit payments, do I owe them? Do they owe me? And this is all before they even collect everything.
Yeah. Let me just remind everybody, this is this is a program, of course, but it's also a conversation, and it's a conversation where we invite you in. If you've got an IRA question, if you're curious about your Roth and whether or not to roll it over, if you're wondering about all the tax news that's been in the headlines, or even have a tax question, now is your chance to throw it out here to ask Ed Slott, one of the nation's foremost experts. You type it into the comments, we'll tee it up and bring it into the conversation. So, Ed, thanks again for being here. You know, there have been a lot of tax headlines of late, a lot of tax headlines about new laws making their way through the channels. In particular, a big retirement act that has made its way through the House, passed by a huge bipartisan vote, and now will eventually move on to the Senate. They're calling it Secure 2.0. What is it all about? What does it mean to us? And what do you think we need to know about it right now?
Well, right now, the key word is you said it's a headline. It's not a law. You know, believe it or not, I still get questions from financial advisors because they saw all the headlines. Oh, Secure 2.0, it's a law. No, some of them I had to send back. I sent them the Schoolhouse Rock video as when a bill becomes a law.
I love that one.
I know. Well, they've updated it. They have a new
Bill.
version now.
Yes,
And I said that. I said, no, it's just a bill. But because of the overwhelming majority, and as you said, I don't know if people realize this passed the full House. First of all, it passed committee last year unanimously. What has ever passed Congress unanimously in recent history? Then it came to the House floor, I think it was last week or the week before, and it passed the House 414 to 5. I'm wondering, who are the 5 people that are anti-retirement?
Well, stop there for a second. What's in this that is making it so overwhelmingly popular?
Well, I think the big item is raising the RMD age, required minimum distributions. Most people can't stand these things. They're forced to take money out. They have you talked about stress before. This causes people stress. They have to do calculations. They check with their advisors. Some people have multiple IRAs. They have 401ks. So the age change from 70 and a half a few years ago to 72. So people are some caught in the middle of the transition. Now this bill says that or proposes to raise the RMD age from 72, where it is now. That has not changed for this year. Maybe for next year to go to age 73. And in an oddball provision there, they said they even want to go to 74 and 75. But under the proposal, it wouldn't hit age 75, get this, until 2033. 11 years out. A lot of people worrying about this. You told people about worrying. Don't worry. You could be dead by then, by the time that comes in. So you don't have to worry about that.
So with RMDs right now, with the age at which you have to start taking them at 72, one of the things that changed in the earlier incarnation of the Secure Act, Secure 1.0, I guess they'll call it now, is that you have to get all of your money out, correct, over a certain period of time. Can you explain how RMDs work?
They work over your actuarial life expectancy. That's a good question, Gene, because in seminars, some people say, well, I'm really healthy. So shouldn't I have a longer life? No, it's not a personal life expectancy. The same thing is, let's say somebody was terminally ill, but if they're 70 something, they still could have a 15-year life expectancy. So it's not based on your actual life expectancy and actuarial like they do with insurance companies, what the age where most people will live to.
I've heard you say that trying to delay these RMDs, that waiting longer to start pulling your money out of your IRAs is actually a trap. And it's a trap as far as taxes are concerned. Can you
Yeah, but
explain that?
Congress likes this because it sounds good. Look, we're letting you have more freedom. You don't have to start taking your money out now, maybe till age 73. But it could be a trap. It sounds good and people like it, and that's why it's so popular with the Secure 2.0. And but if you look at it, at some point, this money has to come out. Now, when I talk to people about planning, I talk about not only during your lifetime, because for many people that have decent sized IRAs or 401ks, a lot of that money will outlive them, will be passed on to their next generation, their children, and maybe grandchildren, which under the current law, most of those children will have to get that money out within 10 years after death. So the longer you put off RMDs, or to put it another way, the higher you raise the RMD age, the shorter the window will be that all the money will have to come out. And when you shorten that window, that means all the money will come out at probably at a higher rate because you're bunching the income into a shorter time period. So even though you can wait longer if this bill goes through, you may want to start a series of voluntary distributions to smooth out the tax bill, the eventual tax bill over your lifetime and for your children.
Well, I know you're a fan. If and granted, let's just stipulate most people don't wait to pull money out of their IRAs. Most people start taking it when they're able to take it without penalty because they need it.
That's
Correct?
exactly right. The Treasury's own statistics, which came out a couple of years ago, they said that 80% of the people take more than the minimum. 80% of the people subject to RMDs take more than the minimum, just as you said, because they need the money. So raising the age, telling these people you can wait 3, 4 more years or whatever, that doesn't help somebody who needs the money. So this is really only a help for the 20% who have maybe other funds to live on and don't need to tap those funds. But even for the 20%, the tax bill doesn't go away. It just gets bunched into a shorter time period.
Okay, so bottom line, be careful with all of this. But if you don't need the money, pulling it out and doing a Roth conversion is, I know, something that you advocate.
I'm a big Roth fan because I love tax free. And I think I've convinced or won over some of my CPA colleagues over the years, because for years I've been a Roth fan. But as CPAs, we're trained, we're hardwired from your first day in college to never pay a tax before you have to. They always banged it into our heads: defer, always defer, put it off, never pay a tax before you have to. I used to say, if when you were a kid and your mother told you to do something and you said, "Not now, Ma, I'll do it later," you would have become an accountant because you were trained to defer, to put things off. But with Roths, I think many of my colleagues have come around to say, maybe it does pay some tax now if you can get the funds out at low rates. And today we have probably the lowest tax rates most people will ever see in their lifetime. So the Roth conversion is basically a bet on what you think your personal tax rates will be in retirement. If you think they'll be higher, the Roth will pay off, even if you pay the tax up front now. Raising that RMD age gives you more time to do Roth conversions before RMDs kick in. Because remember, once RMDs kick in, that RMD, the required minimum distribution, cannot be converted. So it would cost more to do a Roth conversion after you hit RMD age. So you have more years. That's one benefit of them raising the age. You have more years to start planning a series of Roth conversions.
Well, Allison is wondering, and I think you're answering the question that she's asking, but let me just make sure. She says, my mom is 70. Can she roll money from a company 401k into a Roth IRA to be able to withdraw without taxes?
She can move it to a Roth IRA, but not without taxes. This is not what we're talking about. If you convert to a Roth IRA, you will owe the taxes unless there were after-tax funds in there.
Right. So Allison, she'll have to pay the taxes when she does the conversion, but after that point, the money will continue to grow and those withdrawals will be tax-free depending on how it's invested.
Not only that, another thing I love about the Roth, once the funds are in the Roth, there are no RMDs during your lifetime.
James Tim would like to know when Social Security disability will be fixed by legislation. Anything that you would like?
Fixed?
I'm not exactly sure what he means, but I thought I would tee it up for you.
I didn't know it was, maybe I'm not informed on that, but I don't know what the problem is with Social Security disability. Maybe there's some quirk in there I'm not aware of.
Okay, James, if you want to
I
get more
never heard that
specific in
before.
the comments, maybe we can be of some help. So Ed, as we're looking at the landscape, what else is new? What else is different about tax season this year?
Well, we're coming up because this is coming up on tax time now. And once you get into tax time, people always ask, what can I do? Most of that window has closed by the time the year closed, last December 31st. So there's only a few things you can do this year to trim your tax bill, and that could be making an IRA contribution, and taking a deduction for it. But I'm not even a big fan of that. You have to think about taking deductions now while we're in low tax rates. The deductions aren't worth as much. I really think more people have to move towards Roth IRAs, forego the deduction, and start building in a Roth or a Roth 401k at work. So you still have the same time till tax time this year to contribute to a Roth for last year still. Now, it won't lower your tax bill, but you have a window to get more money into a tax-free vehicle.
Suzanne is asking, as a high earner, is a contribution to a Roth 401k a smart move?
Well, this brings on a bigger question. People ask this all the time as a high earner. And the real question is, well, shouldn't I do a regular 401k or traditional IRA while rates are high, based on what I just said? Always pay taxes when the rates are the lowest, and you want to take deductions while rates are the highest. But people believe, and for the most part, this is a myth, that in retirement, they'll be in a lower tax bracket. That almost never happens. Most people that are in a high bracket stay there for the rest of their lives. So then the next question is, people say, but wait a minute, if I don't have a job, won't my income be lower? That's what everybody thinks. But chances are people that were in high brackets tend to have more savings, larger IRAs, larger 401ks. So their RMDs, in many cases, I've done tax returns for people all the time over the years, and they say, and they're retired, and they'll say, Ed, how could this be? My income's higher than my best working years. I thought I'd be in a lower bracket in retirement. So I would still go with that Roth 401k because you'll still have a bigger benefit down the road if rates increase. And I think it's a good bet that for most people, tax rates won't go down.
Right. I actually agree with you. I think if you can afford to pay the taxes now, you pay the taxes now, right? It's money that you don't have to pay later. What we're really talking about with this whole conversation, dealing with taxes, dealing with where to stash our savings in order to build enough money for retirement, is making sure that we actually have enough in retirement to live the lives that we want to live. And I know that one of the strategies that you've used in your own life has been to put some annuities in place. Can you talk about why you made that decision, and who you think they work for versus not work for?
Well, there's something to be said, and I've mentioned this, I think, on every one of my public television specials about having guaranteed income for life. In fact, the only thing better than guaranteed income for life is what I have. So now you're thinking, what does he have that's better than guaranteed income for life? I combine the very strategies I just talked about. I have guaranteed tax-free income for life. That's the holy grail. How did I do that? With annuities in my Roth IRA as a buffer, a guardrail, downside risk, protecting against downside risk in the stock investments I have in my Roth. I don't want everything tied to the stock market with the wild swings you see almost daily. Most people, bottom line, I told you this yesterday, but bottom line, it always is the way. People with guaranteed income, they're just happier people. They don't worry about anything. My own mother, she had this till she died well into her 90s. She had about 4 or 5 of these annuities. It's the best thing that ever happened to our family. She guaranteed her own financial security. She used to love when those checks came in every month, no matter how old she got, no matter how sick she got, or no matter how the market performed. It was her security, financial security blanket. Even at the end, when she was in the hospital, I would come in. She said, Eddie, go to my mailbox and bring me my checks and deposit slips. She loved writing it out and getting it in the bank, knowing that money came in every month. So I think there's something to be said for having some guaranteed income. My rule is whatever your basic monthly living expenses are, that has to be guaranteed. You can't tie that to gains in the stock market. We know the stock market returns over time, but sometimes you run out of time. You don't have the time as you get older to wait for a recovery. I know a lot of the kids say, I'm making all this money in the market, and they can withstand, they have the age, they have the time to withstand a market crash. Oh, and they also have parents that can bail them out. But most people don't. So you have to be careful as you get older. And that's why I cushioned, I'm not saying for everything, my stock investments, like I said, as a cushion, a guardrail, whatever you want to call it, as protection against downside risk. And I did it in my Roth IRA.
We've been experiencing some real turmoil in the bond market lately. It's been a terrible year. I mean, historically terrible year in the bond market, at least so far. I'm wondering if, when you put together your portfolio, the annuity component actually took the place of some of those bonds. I mean,
I
is
actually have
it
both, but
treated like fixed income?
yeah, I actually have both, but because I believe in diversification across the board, except for taxes. I always talk about tax risk diversification because most people have all their eggs in one taxable IRA. I have the opposite. That's just me. I have all my eggs in a Roth. And when I talk about Roths, I'm talking about things I did for myself and my family. I'm a big believer in tax free. So I know if there's downside risk, I eat that, not the government, because it's in my Roth. I also have the bonds, but the annuities, some of the annuities come with, they all have their own bells and whistles. So you have to speak to somebody knowledgeable to see what your particular product may have. But some of them have inflation riders. I have some of these things. And I have to tell you, most people that might not think about annuities, most people already have it. It's called Social Security. It's the best
Right.
annuity that's ever been created. And that absolutely comes with inflation protection.
Yeah, 100%. Ed, the questions are really rolling in here, so I want to take them. Allison asks, are the annuities and stocks in the same Roth IRA or in separate accounts?
So one Roth IRA. You can do it in separate. There's no need to. Today, with most brokerage firms, you can get a whole menu of different investment options under one roof, and it's a lot easier for the tax reporting. You get that one 1099. First of all, if it's in a Roth, I don't even need to do any tax reporting. Another benefit of having it in the Roth, it's all growth is tax free. I could buy and sell stocks all day in a Roth, and it's not even reportable.
Further on that, Colleen is asking the question about whether you can buy annuities in a Roth. So
Well,
can you
obvious,
explain?
yes. I have them myself.
Is there anything specific that you need to know about this transaction as opposed to one outside of a retirement account? I think that's sort of at the root of the question.
Well, obviously, inside a Roth, like where I have it, the funds are growing, and the annuities I've had for years have performed very well, steady, not crazy like markets where it can jump up and go down, but steady, like the turtle finishing the race. It's steady, but steady up a little at a time. That's your downside protection. Now, if you had it in a taxable account, you'd get that same effect. But at some point, if you pulled it out, it would be subject to whatever future tax rates are.
Gotcha. Megan would like to know, is there an appropriate time in one's lifespan to make the move toward annuities versus traditional 401ks and Roth IRAs? And I think, look, I'd like you to answer this, but also in the first iteration of the Secure Act, there is leeway for 401ks to add annuities to their menus. So as that starts to happen, as that starts to come online, when do people need to consider shifting assets into these vehicles?
Well, it's a personal decision, and it might not be either or, like I have both. I think that's a better mix, diversification, because you still want some of the benefits of the upside of the market, but you don't want to get really hit if the market crashes and you don't have the time to recover. Now, in the Secure Act, as you correctly said, more companies are allowed now to offer annuities in the 401k. And as you get older and you're worried about risk, you may want to transition. Although, even though the Secure Act's about 2 years old, I haven't seen many 401ks offer these things. I think it takes them a while, especially big companies, with updating their plan documentation and all the legal stuff. So I haven't seen really a lot of that. You may be better off, if you're interested in that, do it in, say, your own IRA with a financial professional that can explain all the options, the bells and whistles, the payments. That's one thing with annuities. Each product, it's like a car. It has all different options.
Yeah, no, I have to say, I think this is one of those times in your life when you're looking at a menu of choices like this, and you're thinking about this is a big inflection point, right? I mean, when you are taking all of this money that you've accumulated for retirement, and you're figuring out, all right, how am I going to not only make it last for the rest of my life, but provide myself with as little financial stress as possible going forward. If you haven't had a discussion with a financial advisor, now is the time to have that discussion, right? You pick up the phone, you schedule an appointment, you find one. We have a financial advisor finder on hermoney.com. So if you're looking for one, you can certainly go there. But there are many, many places to find a financial advisor. And the Alliance on its website has a wonderful list of great questions to ask a financial advisor if you're shopping for one. And you can find that at protectedincome.org. Colleen is saying she thinks we need a Her Money podcast on annuities. We'll tee that up for you, Colleen, and we'll bring Ed along to help us out. And Stuart is pointing out one can also gift directly to a 501c3 from a traditional IRA with no tax implications. That's a really important tax planning point, right? And as people are thinking of, for those who have an excess of money in their IRAs, or for those who are charitably inclined, it's a way to give more for less. Can you explain?
This is one of my favorite provisions in the tax code. It's called qualified charitable distributions, QCDs. The only downside is that it's not available to more people. It's only available to IRA owners, not 401ks or 403bs or company plans, only to IRA owners or IRA beneficiaries who are 70 and a half years old or older. Now, you might have just heard me say 70 and a half, and we were talking all about the age being 72. In
Right.
work in the Secure Act, they raised the age to 72 for RMDs, but left the QCD age at 70 and a half. So you have more years to make a transfer from your IRA, as you said, Gene, if you're charitably inclined. I never say give your money to charity. Sure, if you want to have no income, give all your money away. That's not the reason. I'm saying as long as you're giving anyway, if you're giving anyway and you qualify for a QCD, do it this way. It will save you taxes because most people, actually 90% of people, are getting no tax benefit of the gifts they give to charity because most people take the new higher standard deduction. They don't itemize anymore, especially with the limits on taxes at 10,000 and other limitations. Most people take the standard deduction, so you're getting zero tax benefit. This allows you to take the most taxed item and get the best tax benefit. IRAs, if you give to charity, are the best assets to give to charity because you're getting that money out of the IRA, and this is money you would have given anyway. You're getting that money out of the IRA at zero tax cost.
Right. Absolutely. I'm a fan of that strategy. I will incorporate it later on in my life. When you're talking about tax, doing your taxes and tax planning and tax prep, one of the questions that I get asked all the time is about that new higher standard deduction. And if you are no longer able to itemize every single year because your deductions don't hit that cap of $12,000 for a single individual, $24,000 for a married couple filing jointly, are there other strategies available to you that you should be implementing?
Well, like I said, the QCD can help lower your IRA balance so that when you start taking RMDs, the balance is lower. So you have this gap now between 70 and a half and 72, which might be 73, where you can start doing your charitable planning. But unless you have huge deductions, and I wouldn't wish that on anybody, I'm thinking about medical, chances are you're going to be stuck with the standard deduction unless they do something about that cap on taxes of $10,000.
The
And
SALT
you
tax, you're
know,
talking about the state and local
yeah,
income tax.
SALT, state and local taxes, and all the itemized deductions. Matter of fact, some people still don't believe it that tax prep fees are not deductible. Investment advisor fees, not deductible. All that went away with an act called the Tax Cuts and Jobs Act. No, they cut the deductions too.
What about bunching?
Yeah, you can do if you have enough, but you have to have a lot. And again, I wouldn't give excess to charity just to get a tax benefit. I always say give the amount you would give, but if you want to do maybe a few years at once and bunch them in, but it would have to be a lot to get over those high standard deduction limits, especially if you're over. You mentioned the limits, but if you're 65 and older, you get extra standard deduction. So it's a higher threshold to get over to get into itemized territory. The only way people do it that I see is with very high, if you're wealthy enough or lucky enough or want to give a lot to charity, very high charitable deductions, and unfortunately high medical bills. But even the medical bills have to exceed 7.5% of your income to be deductible.
Well, I'm wondering if that is something that might apply to James, who's back with a question about tax breaks for people with disabilities. It would if the medical bills exceed a certain level, would that be of help?
Oh yeah, but it would have to be very large. For example, let's say somebody had 100,000 of income. The first 7,500 of medical wouldn't even count. The first 7.5%. So it has to be large amounts. This is why 90% of the people take the standard deduction now. And for older people, 65 and older, who get the extra standard deduction, the percentage is much higher.
Earlier in the show, I was talking about a survey on taxes this year from the folks at Retail Me Not. 39% of people will use tax software to prepare their taxes. I'm often asked, who is this right for, and who actually needs a tax preparer, an enrolled agent, an accountant? You're a CPA. What I know, you no longer are in the business of doing taxes for people unless they're a part of your family.
That's right.
But what would you say?
There's certain clients you can't get rid of.
What would you recommend in terms of the need for tax help?
Well,
Who
if you have
actually?
a straight W-2 and Social Security and some interest and dividend income, you could probably easily do that on your own. But if you need planning help, you said something earlier that I don't think you realize how important the distinction was. You talked about tax preparation and tax planning. They're two totally different things. Preparation is really just reporting history. You're just writing down things that already happened. You're looking backwards. Planning is looking prospectively forward. So that's where you might get help from a professional tax advisor to say, well, maybe you should do more, like the question we were talking about with Roth conversions or other strategies, or where you should have your investments. And we talked about annuities. So in the planning concerns, I don't think it's, unless you have some complicated issues, putting the numbers on the forms with software is not as hard as it used to be if you know what you're doing. It's like fixing a car, which I would never do. I want to drive it. I don't want to know what's under the hood. So if you're like me, maybe you're better off doing what you do best and have somebody that can both do the preparation but prospective planning with you. I think there's more value in the looking forward, the planning part.
Yeah, 100% agree with you on that. Okay, one more stat from this survey. 81% of people are expecting a refund. First of all, I think that number is much too high. And maybe there's some anomaly about this year, but is this normal that so many people are getting a refund as far as you expect? And isn't it a bad idea to get a refund if you can avoid it? Right? You're just giving Uncle Sam an interest-free loan.
It depends what kind of person you are. For years, I've had clients that love big refunds. It's their way of savings because they would spend every dollar in their paycheck if they didn't have the extra withholding. So when they come in and they get a $300, $500,000, $2,000 refund, that's like found money, saving. So if that's your mentality, but if you think you could save on your own, everybody thinks they can. But there are a lot of people live paycheck to paycheck. So the last thing people want is to owe money. I've seen it both ways. When I've done people's taxes and they owe money, you could see the color drain out of their faces like, well, I don't have that money now. But when they get a refund, there's never a problem.
Yeah, no, it's always a shock. Young in my youth, I went on Wheel of Fortune, and
Oh,
I won some prizes. This was in the days before they had actual cash. They gave you these prizes that nobody used, and then I owed taxes on these prizes, and I was just blown away. It was before I was a financial reporter, so just, you're right. Beware. Kathleen writes, can you convert a SEP IRA to a Roth IRA?
yes, a SEP is an IRA.
Okay. All right. I
But
think
you
people
do
get
have to pay the
confused.
taxes. I never want
Of
people to
course.
think when we say, oh, you could just do it, there is a tax bill.
Right, right. But I think people, there are SEP IRAs and Roth IRAs and traditional IRAs and non-taxable. There's
There are
there's
too many different kinds
yes,
of
but
all these
they can
plans. I
all
spent
be
my
converted.
professional life studying retirement plans, and there's just too much.
Yes, yes, 100%. Ed, you are incredibly knowledgeable about all of this. For people who are watching, who, as soon as we stop this broadcast, will have an IRA question, where should they go?
Well, they can go to my website. We answer, a lot of people don't know this. I have a whole team that answers the toughest IRA questions. You go to, I think you have it there, IRAhelp.com, and hit a question. Matter of fact, there's a spot on our website that says, we want your questions. And there's no fee or no cost. And, answer the toughest questions. I have me and my team of IRA experts. And you should, matter of fact, even if you don't have a question, go to the site and look at the answers to other people's questions, and it might open your eyes and you say, you can do that?
You can absolutely do that. Thank you so much for being
Okay.
with us. Once again, we will certainly call on you again in the future for more information on the work of the Alliance for Lifetime Income and on this webcast in particular. You can go to protectedincome.org. That's our website, protectedincome.org/slot is where you'll find the information about this conversation. Ed, always a pleasure. Thank you so much for being with me.
Thanks, Gene. I love talking taxes. Sorry to
Oh boy,
say.
oh boy, you and you alone. Thanks, guys. See you next time.